Hi everyone, today's topic is cash flow that related to the capital budgeting. The principle that apply to this chapter is principle 3, right? Based on the first chapter, cash flow are the source of the value, and the chapter and principle 5, individual respond to incentives. So the corporate finance address the following 3 questions, right? As we know, once you finish this course, you should be able to answer these 3 questions, right? Number 1, what should be the long-term investment should the firm engage in? Number 2, how can the firm raise up the capital, right? You can have bonds, stock, preferred stock. And number 3, how much short-term cash flow does the company need to pay its bill, right? Or how to manage the working capital. So this chapter will concern only the question number 1, right? Or the capital budgeting, right? You need to know the concept of capital budgeting in order to pick the right investment. For example, capital budgeting is the process of planning for purchase of long-term asset. This is what you need to know, right? This is the definition of capital budgeting. For example, the firm must decide whether to invest a new ABAC, right? Let's say this campus, right, at Beijing, for the cost at 12 million. How do you decide, right? How do we decide? Of course, right, based on the previous chapter, you need to make sure that this project is generating the profit, or profit comes from what? Revenue, which is greater than cost, right? So, or NPV is positive. Or you can also use the internal rate of return, right, to compare with weighted average cost of capital. If the internal rate of return is greater than WCC, we should accept the project, right? So what you need to know in order to get to the answer, accept or reject, you need to know all the related cash flow, right? So this chapter we will talk about how can you find the related cash flows, right? So we have 3 group of cash flow that we need to find, right? Number 1 is initial outlay. Okay, this is the money, the initial money that the firm need to pay, right, for the project. Annual cash flow, right? Once you pay for your capital, right, set up everything, and then you start to operate, how much should be the cash that you generate from operation? And after you cut from maybe the firm use some new capital to invest, right? And sometime in some year, the firm might spend cash for some working capital. So whatever left, it goes to free cash flow, right? So we will talk about the free cash flow later. And last one is terminal cash flow, or the salvage value, adjust with tax, right? And then liquidate with all working capital. So it includes to be the terminal cash flow or terminal value. Number 1, you have to find all related cash flow. Number 2, you need to find the discount rate. Okay, the discount rate. How do you get discount rate? You need to look back at initial outlay. How much do you spend for the project, right? And what should be the source of the money, right? Where should be the source of? If you raise the capital by using, common stock, bond, and preferred stock, the cost of that capital should be the WACC, right? So the discount rate should be weighted average cost of capital, and then we will use the WACC as the discount rate. And number 3, right? After you know discount rate, you can calculate NPV. Maybe you can use IRR to make investment decision, accept or reject the project.